We had that positive US jobs data last Friday, which sparked a nice recovery on our markets through to the beginning of this week. But it looks like everything has now gone belly up and reacting to some of the bad data we're seeing.
Yes, very much so, Stephen. I think it's a case of, there's still conflicting data coming out, some good, some bad, and it really just is indicative of the noise levels in the market worldwide at the moment, where there's really conflicting views, conflicting data, both from an economic point of view and from a company or a corporate specific point of view, and it's really quite difficult to see through all this noise and all the cloud to get a good sense of the medium to long-term direction. And I think that's one of the concerns that investors are dealing with at the moment. When we look at the US trade figures that came out yesterday, although it slid again and it was an increase in that trade deficit, I think what was maybe a positive surprise was the sharp rise in the exports, the sharpest since 1994, so certainly a very big jump in the exports, and obviously that came on the back of the weaker dollar, but also in terms of their ability to actually offer cheaper goods and certainly from the manufacturing point of view into the rest of the world. So I think if we look back on that jobs data last Friday, I think it's indicative of a US economy that is able to make use of the weaker dollar and actually stimulate its export industry, certainly something which will assist over the medium to long term on addressing these massive global imbalances in the world. We do need the US economy to export more, manufacture and export more, and we do need the Asian economies to lift their internal demand and get their own imbalances sorted out as well. So although things are very negative and very red today, I do believe that the underlying picture is showing some signs of things moving in the right direction.
And of course, you're dressed very appropriately for this Red Thursday, Nerina. Perhaps to take a look at one of the other causes of the imbalances globally, and that's China, because we've had lots of data out of China this week. We had the inflation numbers slightly higher than expected, but starting to trend downwards. We also had industrial production and some retail data as well. And it looks like the Central Bank of China, or the People's Bank of China, has achieved what it sets out to achieve by tightening monetary policy, because it is starting to slow demand from China.
Most definitely, and I think that's exactly what we can attribute the sharp drop in commodity prices, the broader commodity spectrum, so not just gold or even just oil, but the broader spectrum. When we look at copper, for example, copper is certainly a great leading indicator for the basket of metals and industrial metals that are used in the industrial production process. And copper has given us a firm indication of that expected decline in demand coming from China. Gold and oil, of course, have got their own sort of specifics that are associated with it. Gold more associated with a safe haven status, with an alternative investment class, and oil on the other hand, yesterday we had some oil inventory numbers out from the US that showed that those inventories were sharply higher, and then that certainly also led to the oil price being lower. So when you combine all of these things, the low oil price, the low gold price, the lower industrial commodity prices, really the CRB index, which is the broad commodity price index, down over 3% since yesterday, and not surprising therefore to see that our market is taking the strain that it is today, with most of our resource counters being sharply in the red.
Would you expect some of this unwind to continue, because it looks like there were lots of long positions in commodities in the market, and this is really just an unwind of some of those positions?
Well, Stephen, I think there's a bit of a double whammy effect going on at the moment. Greece, of course, is currently leaving quite a serious pall over Europe and its sovereign debt crisis. So whilst that is playing down, a part of the safe haven status is certainly being found in US treasuries, and certainly in the longer dated US treasuries as well. So we've seen the dollar strengthen massively from close to the 150 to the euro level to where it is at the moment, around 142. So a very big move in that sense. And a lot of it came on the back of money flowing back from Europe and the rest of the developed market into US treasuries. And it's a combination of, expectation of maybe China not being able to grow quite so robustly in future, but it's also indicative of the relative growth outlook for US and Europe, or the European region. So I think the dollar has certainly played a big role in that as well. When we look at the commodity prices, all denominated in dollar terms, what we of course see is the combined effect of a decreased demand for the commodities, but also the strength in the US dollar.
Well, just to perhaps illustrate that, let's take a look at the Rand gold price, because we were chatting earlier and you did point out that that Rand gold price, while not at record highs, isn't very far off those record highs.
Yes, it's very fascinating when you think about it. We tend to get excited when commodity prices, and especially the gold price, is very high in dollar terms, and yet that's usually when the Rand is quite strong, so that the impact for the local gold producers and for our export scenario and so on is actually not that great. Today we find ourselves in the opposite scenario, where the gold price in dollar terms is falling sharply and coming off those recent highs, but now the dollar Rand, or the Rand dollar, is weakening to such levels that we are sitting at around about 10,300 Rand per ounce, which certainly is a very, very comfortable level and a very good indication of increased potential margins for the gold producers. So one really do need to look at these things with from more than one angle, and not only focus on those dollar-based commodity prices.
And Nerina, here's a bit of a plug for Nedbank Capital. We chatted last year when you launched your equally weighted top 40 ETF. I think it's called the Better Beta ETF. This has now been listed on the Botswana Stock Exchange in Gaborone. Take us through the rationale for putting this ETF onto the Botswana Stock Exchange.
Yes, Stephen, thank you for the opportunity. You know, this is really, I think, the culmination of many years of hard work, particularly by the Botswana Stock Exchange themselves. 3 years ago, they started this process of trying to address a severe lack of liquidity and choice of investment products in their own market. And they started by getting all the industry players together and say, what would we need in order to bring ETFs to our market? This involved the registrar, the Ministry of Finance, the stock exchange themselves. It was the lawyers, it was the asset managers, the stockbrokers. And as a result of this concerted effort of what they put together, ABSA was able to list the new gold ETF, deal list that on the Botswana Stock Exchange in July last year, and we were able yesterday to deal list the first equity-based ETF on the Botswana Stock Exchange. The reason for this being such a great product for the Botswana market is that their domestic index, as they have it, is over 85% financials. So not only a lack of available investment product, but certainly also a lack of diversification. Many of the asset managers are already invested in South African shares, in shares on the JSE, but they have to invest in them currently as foreign shares. And with the introduction of the ETF in their market, they can now invest in these as a local asset. It's listed and trading on their own stock exchange, and it means that they can accrue a lot of that benefit to the Botswana market. So it's been a long process, but an extremely rewarding process, and I think a great accomplishment for the Botswana financial market and the stock exchange in particular.
Nerina, we're almost out of time. We had a couple of numbers out this morning. We had Old Mutual out with its interim management statement, Able out with a trading statement as well. And it looks like the market hasn't responded well, particularly to the Able trading statement. Yes. I suppose it is a pretty red day all round today.
Yes, although Able is particularly red today. I think the big disappointment there comes from the fact that we had a very positive trading statement from them after the first quarter. And on the back of that, the market was expecting that numbers could be up by as much as 30%, because they did come off quite a low base in the first quarter last year. The 20% number is far shy of that, and the market is really giving them a pounding because of that. So I think the concern is that if the sales numbers or the revenue numbers in the first quarter was that good, this can only mean that it's either increased impairments or that the revenue yields on the new products that they've launched is not as good as the market expected.